Washington has just crossed a line. Despite the Trump-Xi meeting meant to calm tensions, the U.S. has unleashed a stunning 145% tariff on Chinese goods, and the global market is bracing for impact. But behind the bold move lies something deeper, a sense of desperation. With supply chains slipping away and allies hesitating, Washington is running out of options, and talk inside the administration hints at even harsher measures. Tariffs as high as 500% if Beijing doesn't yield. In Beijing, silence doesn't mean surrender. China is preparing to strike back with something far more powerful than tariffs: rare earths, the invisible backbone of the modern world. These metals power smartphones, electric vehicles, and fighter jets, and China controls nearly half of them. When that supply is threatened, the entire global economy trembles. At the same time, Scott Bessent, Trump's Treasury chief, is scrambling to rally a coalition against Beijing. But even America's closest allies rely on Chinese materials. And as this new trade storm builds, investors are rushing for safety, sending gold to record highs above $4,200. What's unfolding now could redefine global trade and the balance of power itself. Trump's new 145% tariff on Chinese goods has sent shockwaves through global markets. It's the biggest escalation in years, announced suddenly, without Congress, through an executive order signed overnight. The White House framed it as a move to protect American industry, but the numbers tell a different story. Last year, U.S. imports from China still topped $427 billion, covering everything from microchips and batteries to medical equipment. Now, almost all of it faces a price wall. Within hours, markets reacted. Logistics firms halted shipments, factories in California and Texas warned of cost spikes, and retailers like Walmart and Home Depot started raising prices. Economists from Goldman Sachs estimate these tariffs could add 0.6 percentage points to U.S. inflation within months, hitting consumers long before manufacturers recover. Even America's allies are anxious, since many of their products depend on Chinese components routed through U.S. supply chains. In Beijing, the shock quickly turned into calculation. China's Ministry of Commerce called the move economic sabotage. But behind closed doors, officials began drafting a more strategic response. Instead of matching tariffs dollar for dollar, they looked at rare earths, an area where China holds overwhelming leverage. With half of global reserves and around 90% of global refining capacity, Beijing can pressure the U.S. where it hurts most, in high-tech manufacturing. And while Washington talks about reviving domestic production, experts warn that building a full supply chain from scratch could take a decade and trillions of dollars. As a result, the new tariffs don't just punish China. They risk choking America's own industries. What began as a display of strength is turning into a race against time, as Beijing quietly moves to weaponize the very materials that power the modern world.
What is a fulsome response? What does that mean?
We have lots of levers that we can pull for products that they need.
That uncertainty revealed what markets already suspected. Washington's options are limited, while Beijing's leverage runs deep. And that leverage comes from one resource the U.S. can't replace: rare earths. These are 17 metals that sound obscure but are essential to modern life, used in electric vehicles, wind turbines, smartphones, and missiles. Without them, the high-tech world stops. China dominates this market like no other country controls any resource on Earth. It holds around 38 to 40% of global reserves, but its real power lies in processing, refining nearly 90% of the world's supply. No other nation even comes close. That dominance didn't happen overnight. For decades, China poured billions into mining, refining, and recycling facilities while others shut theirs down due to cost and pollution. Today, that early investment gives Beijing extraordinary leverage. According to the European Commission, Germany depends on China for 91% of its refined rare earths. The UK relies on 89%, South Korea about 80%, and Japan roughly 58%. Even the United States, despite its ambitions to diversify, still imports over 70% of its supply directly or indirectly from China. And the network doesn't stop there. The rest of the global reserves are largely held by China's strategic partners, Brazil, India, and Russia, all part of BRICS. Together, they control nearly every significant untapped deposit. That means any coordinated restriction could reshape global trade in a matter of weeks. China doesn't need to ban exports outright to cause chaos. Even a small licensing delay or export quota can drive prices sky high. We've already seen this before. When Beijing briefly tightened controls in 2010, global prices jumped up to 700% within months. Now, analysts warn that even a 0.1% share of Chinese rare earths in any exported product gives Beijing a legal and strategic foothold over that trade. With supply chains stretched thin and costs soaring, this quiet resource battle is becoming the real front line of the global economic war. Scott Bessent, Trump's Treasury Secretary, is now trying to turn this trade fight into a global campaign. His plan is to build an economic alliance to isolate China, bringing together the EU, Australia, Canada, Japan, and India under one strategy. On paper, it sounds like unity. In reality, every one of these countries depends on Chinese goods, components, or raw materials to keep their own industries alive.
As the president has said, we want to help China, not hurt it. If some in the Chinese government want to slow down the global economy through disappointing actions and through economic coercion, the Chinese economy will be hurt the most. And make no mistake, this is China versus the world. They have put these unacceptable export controls on the entire world. China is a command and control economy, and we and our allies will neither be commanded nor controlled.
The numbers make this clear. China is the largest trading partner for more than 120 nations and accounts for about 15% of global exports. Europe alone imports nearly $600 billion worth of Chinese goods each year, while Japan and South Korea rely on China for over 1/3 of their critical minerals and electronics inputs. Even India, seen as a U.S. ally, sources nearly 30% of its imported machinery and active pharmaceutical ingredients from China. Asking these countries to cut China off is asking them to harm their own economies. Bessent is aware of that weakness. So instead of direct threats, he's offering what he calls a flexible partnership, extending tariff deadlines and trade exemptions to buy cooperation. It's the diplomatic version of stalling for time. But allies are skeptical. European leaders fear another wave of inflation if Chinese goods become more expensive. Australia is cautious too, since over 30% of its exports still go to China. Behind the smiles at summits, frustration is growing. Washington wants loyalty, but its partners need stability. Every meeting ends with the same dilemma: follow America's lead or protect domestic industries tied to Beijing. As Bessent tries to hold the coalition together, China quietly strengthens its own networks, deepening trade with BRICS and the Global South, turning this contest from a tariff battle into a struggle for global alignment. Scott Bessent's latest move has stunned even his own allies. In an attempt to tighten pressure on Beijing, he's now linking China's trade with Russia directly to U.S. sanctions.
We are sitting here during a government shutdown when we can't get 7 more Democratic senators across the line, but 85 U.S. senators are willing to give President Trump the authority to put up to 500% tariffs on China for the purchase of Russian oil.
That statement sent markets into panic mode. A 500% tariff on China isn't just extreme, it's financial self-destruction. It would shatter global supply chains and tank the U.S. economy within minutes, while pushing Beijing and Moscow even closer together. The reasoning is clear. Washington wants to choke Moscow's oil revenue while forcing Beijing to pick sides. But the strategy is full of contradictions. China doesn't seem to stop purchasing Russian oil. It gives Beijing enormous leverage in manufacturing, especially during this trade war. China now buys roughly 2.2 million barrels of Russian crude per day, nearly 40% more than last year, making it Russia's top energy customer. Those purchases aren't slowing, they're accelerating. Most payments now flow through yuan-based systems or local bank swaps that bypass the US dollar entirely. Trump claimed India had agreed to stop buying Russian oil, presenting it as a diplomatic victory. Yet the data tells another story. India's imports remain near 1.7 million barrels a day, according to Kepler and Reuters, with a growing share settled in yuan instead of dollars. Russian crude now accounts for around 35% of India's total oil imports, compared with just 2% before the Ukraine war. The cheap price, often $5 to $7 below Brent, keeps Indian refiners hooked. So while Washington talks tough, both China and India are deepening energy links with Moscow. For Russia, this shift secures stable revenue. For China, it guarantees cheap fuel for its factories. And for India, it strengthens its strategic autonomy. Together, they're quietly redrawing the global oil map, one that works outside the dollar system and beyond Washington's reach. And that's where the real pressure on the U.S. economy begins to build. Gold has exploded past $4,200 an ounce, climbing more than 5% in just a week, its fastest surge since the pandemic. The rally began quietly after Trump's tariff shock, but gained momentum as markets realized what it really meant. More inflation, more uncertainty, and more money printing to cushion the damage. Investors are now rushing to safe assets, and gold has become the ultimate refuge again. Global demand is hitting record levels. According to the World Gold Council, central banks bought over 1,100 tons of gold in 2024, the highest in modern history, led by China, India, and Turkey. These countries are reducing exposure to the US dollar and building reserves in physical gold instead. Meanwhile, hedge funds are jumping in. Bank of America reports that major fund managers still hold just 2.4% of their portfolios in gold, a tiny number that leaves room for a major wave of buying if fear spreads. Even Wall Street skeptics are changing their tune. Jamie Dimon of J.P. Morgan, who once mocked gold as dead money, now admits the landscape has shifted. Speaking at Fortune's conference in Washington, he said gold could easily go to $5,000, $10,000 in environments like this, calling it one of the few times in his life it's semi-rational to have some in your portfolio. For everyday investors, this surge isn't about fascination with metal. It's about trust. Gold isn't rising because people suddenly love metal. It's rising because faith in the dollar is collapsing. Every ounce bought today reflects growing doubt in Washington's ability to manage debt, trade, and inflation. And that's the real signal behind this entire crisis. The biggest risk now isn't what most investors think. Just a few months ago, Wall Street saw the AI bubble as the top threat, while the trade war seemed contained. But that has changed fast. As tariffs rise and China quietly tightens its export rules, the danger is shifting from overvalued tech stocks to a full-scale global slowdown. Economists are starting to warn that the next shock could come not from markets, but from policy mistakes. If Bessent keeps escalating and Beijing strikes back with rare earth restrictions, supply chains will seize up again. Production costs will soar, pushing inflation higher just as growth weakens. The perfect recipe for stagflation. The Federal Reserve would then face a brutal choice: raise rates and crush the economy, or print money and risk destroying the dollar's credibility. Neither path looks safe. U.S. debt has already climbed past $37 trillion, and interest payments now exceed $1 trillion a year, more than America spends on defense. A new wave of stimulus could push the dollar into a long decline, sending gold and commodities even higher. What's happening now isn't just another trade dispute, it's a global reset of power. The United States can still create money, but it can't manufacture the resources or confidence that once backed it. In a world built on real assets and shifting alliances, those who control production will shape the future. Every empire fades not because of enemies abroad, but because of decay within, debts, divisions, and lost faith in its currency. Those cracks are spreading through America's foundations. Can Washington restore balance before the world moves on? Or has the next superpower already stepped forward? Share your thoughts below, and don't forget to like and subscribe for more deep dives.